Jake and Marcus are both 25 years old. They both live in Dallas. They both earn $70,000 a year. They both have exactly $10,000 sitting in a savings account, and they both decide today's the day they're finally going to get serious about building wealth. Jake makes one decision. Marcus makes another. Jake decides he'll wait until he has a much bigger amount before investing, because, in his mind, investing small amounts can't possibly make a difference. Marcus decides to start immediately, even though his contributions feel almost embarrassingly small. They both walk away convinced they made the smarter choice. And strangely enough, they're both wrong. Because the biggest mistake isn't investing too little, and it isn't waiting for more money. It's misunderstanding the one number that quietly determines whether compound interest crawls or suddenly explodes. By the end of this story, the gap between these two ordinary workers won't just surprise you. It'll completely change the way you think about investing. And to make this comparison as fair as possible, they start with identical salaries, identical savings, identical raises, identical living expenses, and identical investment options. The only thing that was different is how they treat one number that almost nobody pays attention to. Most people think compound interest is about finding the highest return. 8% sounds better than 6%. 10 sounds better than 8. That's what headlines focus on. But the return rate isn't usually the number that changes your life. The number that does is far less exciting. It's time. Time doesn't make the biggest difference at the beginning. That's why people ignore it. During the first few years, time almost looks disappointing. The account grows, but not dramatically. That slow start tricks people into believing compound interest isn't working. In reality, it's doing exactly what it's supposed to do. Jake looks at his $10,000 and decides it isn't enough. He tells himself he'll wait until his career advances. Maybe after a promotion. Maybe after his next raise. Maybe after he's saved another $40,000. Then he'll invest. Until then, the money stays inside a high-yield savings account, earning around 4% annually. That's safe. It's predictable. It feels responsible. Marcus looks at the exact same $10,000 and reaches a different conclusion. He opens a low-cost index fund and invests the full amount. Then he commits to adding $500 every month automatically. He doesn't wait for motivation. He doesn't wait until investing feels exciting. He simply schedules the transfer and lets it happen. One decision creates excitement because waiting feels comfortable. The other feels almost boring because nothing dramatic happens after pressing the invest button. Feelings and math are two very different things. Let's assume Marcus earns an average annual return of 8%, roughly in line with the long-term historical performance of broad U.S. the stock market indexes before inflation over many decades. Markets never produce exactly 8% every year. Some years are much higher, others are negative. But over long periods, this average provides a useful illustration. Meanwhile, Jake earns 4% in his savings account, a rate that resembles many high-yield savings accounts during periods of elevated interest rates, although those rates change over time. The important point isn't predicting the future. It's understanding how different growth rates interact with time. Historical market return data published by organizations tracking broad U.S. equity indexes has consistently shown that long-term investing rewards patience more than perfect timing. After 1 year, Jake feels pretty good. His savings account grows from $10,000 to roughly $10,400. He also saves another $6,000 during the year, bringing his balance to approximately $16,400 before taxes on interest. Interest earned inside many taxable savings accounts may be subject to federal and state income taxes, depending on where you live and your personal situation. If Jake falls into a combined tax rate of roughly 22%, he could owe around $88 on the $400 of interest he earned. It's not devastating, but it's one of those tiny frictions people rarely include when comparing returns. Marcus has a different experience. His original $10,000 grows to about $10,800. His 12 monthly contributions of $500 add another $6,000. Plus, those contributions begin earning returns almost immediately, depending on when they've gork. By the end of the first year, his portfolio sits around $17,300. The difference between them, less than $1,000. That's it. Most people would look at those numbers and shrug. Jake certainly does. He thinks, I waited 1 year, stayed completely safe, and I'm barely behind. On paper, that's true. Sounds great until you subtract everything else. Inflation quietly reduces purchasing power. If inflation averages around 2.5% over long periods, Jake's real return after inflation is much smaller than his headline interest rate. Taxes reduce it again. Suddenly that comfortable 4% doesn't feel like 4% anymore. Marcus deals with volatility instead. Some months his account drops. Some months it jumps. Watching thousands of dollars disappear temporarily isn't enjoyable. That's the emotional price investors pay for pursuing higher long-term expected returns. Neither path feels perfect. That's exactly why so many people hesitate. Now fast forward to year 3. Jake has continued saving diligently. Every month another $500 enters the savings account. His balance has climbed to roughly $30,400. The steady growth reinforces his belief that patience is paying off. He hasn't worried about stock market headlines. He hasn't experienced any scary downturns. Sleeping at night has been easy. Marcus reaches the same 3-year mark. His portfolio has grown to approximately $33,800. Now the gap has widened to about $3,400. Still not life-changing. Still small enough that Jake doesn't regret his decision. And that's the trap. Compound interest spends years looking unimpressive. People mistake slow progress for failure. But underneath those balances, something much more important is happening. Marcus is no longer earning returns only on his original $10,000. He's earning returns on previous returns. He's earning returns on every monthly contribution. He's earning returns on gains generated by earlier gains. His money has quietly started hiring more money. Jake's savings account compounds too, of course. But after taxes and inflation, much of that compounding power is muted. The engine is running. It's simply running at a much lower speed. Think about it this way. Imagine 2 snowballs rolling down the same hill. For the first few feet, they almost look identical. One is only slightly larger. Nobody watching would predict what happens next. But as both snowballs continue rolling, the slightly larger one begins collecting more snow every second. Its bigger surface area gathers even more snow. That extra snow creates even more surface area. The advantage starts feeding itself. Compound interest behaves the same way. Not because the math changes, because the base keeps getting larger. And that's the number almost nobody watches. Everyone asks, what's the return? Almost nobody asks, how much money is now generating returns? Those are completely different questions. By year 5, the answer starts becoming impossible to ignore. By the 5th year, Jake finally feels vindicated. His savings account has grown to roughly $44,000. He's proud of the discipline it took to get there. Every month, another $500 went into the account. He never missed a deposit. He never panicked because of a market crash. He never had to watch his balance fall 20% in a bad year. His money was always there, exactly where he left it. Marcus reaches the same 5-year mark. His investment portfolio is now worth about $51,000. For the first time, the gap isn't measured in hundreds of dollars. It's roughly $7,000. $7,000 isn't enough to retire on, but it's enough to buy a reliable used car. It's enough for a house down payment in some markets. It's enough to cover several months of living expenses if life suddenly goes sideways. Jake notices the difference, but he isn't worried. He tells himself, markets got lucky. Maybe they did. Maybe they didn't. The important part isn't whether one particular 5-year period happened to be good or bad. The important part is what's happening underneath the numbers. Marcus's portfolio isn't just earning returns anymore. It's earning returns on over $50,000. Every future percentage gain now applies to a much larger base. That's the hidden accelerator. Most people think compound interest suddenly turns on one day. It doesn't. It simply reaches a point where the dollars being earned every year become larger than the dollars you're contributing. That's when it feels like an explosion. But the explosion was built slowly, quietly, over thousands of ordinary days. On paper, Jake earned about $1,700 in interest over the previous year. Sounds great until you subtract everything else. Interest from taxable savings accounts is generally taxed as ordinary income under IRS rules. Depending on your tax bracket, that can reduce your effective return every single year. Inflation keeps reducing purchasing power. And if interest rates fall, as they often do over economic cycles, that attractive 4% may not stay around forever. The FDIC ensures eligible bank deposits up to applicable limits, but it doesn't guarantee that today's interest rates will last. Marcus has his own hidden costs. His investment account may experience a year where it loses 15% or even 25%. Broad stock markets have experienced declines larger than that throughout history. The difference is that temporary volatility isn't the same thing as permanent loss unless you sell during the downturn. That's an emotional cost. And emotional costs are real. Some investors panic. Some stop contributing. Some sell everything at exactly the wrong time. The math only works if your behavior allows it to work. Now let's move to year 10. This is where almost every conversation about compound interest starts getting interesting. Jake has now spent a decade doing exactly what he planned. His account has grown to approximately $87,000. He's proud of himself. Honestly, he should be. Saving consistently for 10 years already puts him ahead of many households that struggle to save it all. Discipline matters. Marcus also stayed disciplined. He ignored the headlines. He continued investing $500 every month, whether markets were rising or falling. His portfolio has grown to roughly $116,000. Now the difference isn't $7,000 anymore. It's nearly $29,000. Nothing about Jake changed. Nothing about Marcus changed. The return rate didn't suddenly double. The monthly contribution stayed exactly the same. The only thing that changed, was time. That's the number nobody brags about. People love posting investment returns online. They'll tell you they earned 18% last year, or 24%, or they'll brag about picking the perfect stock. Very few people tell you they've simply stayed invested for 20 years. Because patience isn't exciting. But patience is usually where the math lives. Here's something almost nobody talks about. The flashy number everyone celebrates is annual return. The hidden number is invested years. A portfolio earning 8% for 20 years often beats a portfolio earning 15% for only a handful of years before the investor quits. Behavior usually matters more than brilliance. That's why the real question isn't, what's the highest return? It's, how long can you realistically keep your money invested? Now let's talk about the layers hiding underneath the headline numbers. First, taxes. People often compare investments using pre-tax returns because the percentages look cleaner. Real life isn't pre-tax. Interest earned in taxable savings accounts is generally taxable each year. Investment accounts may also generate taxable dividends and realized capital gains. Although long-term capital gains in many situations receive different tax treatment than ordinary income. The exact outcome depends on account type and personal circumstances. The headline return isn't always the return you actually keep. Second, inflation. If prices rise 3% annually while your money earns 4%, your purchasing power grows much more slowly than the balance on your banking app suggests. The account balance increases. Your buying power barely moves. That's why economists distinguish between nominal returns and real returns. Third, investment costs. Marcus didn't buy an expensive mutual fund charging a 1.5% annual management fee. He chose a broadly diversified low-cost index fund with an expense ratio measured in just a few hundredths of 1%. That sounds tiny, but imagine paying an extra 1% every year for 30 years. The fee compounds too, except it compounds against you. A 1% annual fee on a growing portfolio can easily reduce ending wealth by tens of thousands of dollars over several decades. Fourth, timing mistakes. Many investors accidentally buy after excitement peaks and sell after fear peaks. Research has repeatedly shown that investor behavior often trails the returns of the investments themselves because people chase performance instead of following a disciplined. The investment wasn't the problem. The timing was. Fifth, opportunity cost. This one almost never gets discussed. Every year, Jake waits before moving his money into long-term investments. Isn't just another year. It's another year that future compounding can never recover. You can replace dollars later. You cannot replace lost years. A dollar invested at age 25 has something age 35 can never buy back. 10 extra years of compounding. That's why waiting for the perfect moment is usually far more expensive than choosing the perfect investment. Now imagine a completely different pair of workers. Meet Derek and Travis. Both receive a $50,000 bonus from selling a small business. Derek decides he'll wait until the market feels safer. He parks the money in cash for 3 years. Travis invests immediately into the same diversified portfolio Marcus chose. Nobody knows what the market will do over the next 3 years. That's the point. Waiting feels like reducing risk. But waiting also guarantees missing any growth that happens while you're goat. And we're sitting on the sidelines. If the market averages 8% annually during those 3 years, Travis's original $50,000 becomes roughly $63,000 before adding another dollar. Derek still has about $50,000 plus whatever cash interest he earned. That gap now compounds for every future year after that. The decision wasn't just about 3 years. It affected every year that followed. That's how compound interest quietly magnifies small timing differences into very large, lifetime differences. And yet, if I only showed you the downsides of waiting, I'd be doing exactly what many investing influencers do. Because waiting isn't always wrong. Investing immediately isn't always right. The numbers deserve a fair comparison. And that's where the story takes another turn. If I only showed you the downsides of waiting, I'd be doing exactly what every investing influencer complains everyone else does. Real life is more complicated than that. There are situations where keeping money out of the market is absolutely the better decision. If you're carrying credit card debt at 24% interest, paying that off first is often a guaranteed return that's difficult for investments to match. If you're planning to buy a house in the next year or two, putting your down payment into a volatile stock portfolio could leave you with less money exactly when you need it. If you don't have an emergency fund covering 3 to 6 months of expenses, investing every spare dollar could force you to sell during a market decline just to pay an unexpected bill. Those aren't emotional arguments. They're mathematical ones. Likewise, Marcus's strategy has real disadvantages. His account won't move in a straight line. A diversified stock portfolio can decline 30% or more during severe bear markets. If he checks his balance every day, there will be periods where years of gains appear to disappear in a matter of months. That's emotionally difficult even for experienced investors. There's also sequence risk. If Marcus needs the money immediately after a major market decline, his timing could permanently reduce his long-term wealth. Liquidity matters. Time horizon matters. Risk tolerance matters. That's why the winning strategy only wins when the conditions match the strategy. Now let's zoom out another decade. 20 years have passed. Jake is now 45 years old. Marcus is 45 too. Same career, same income progression, same city, same monthly savings habit. The only meaningful difference was when they allowed compounding to begin. Jake's savings account has grown to roughly $196,000 after 20 years of disciplined saving and interest. That's a remarkable achievement. Very few households accumulate nearly $200,000 through consistent saving alone. Marcus's investment portfolio has grown to approximately $355,000, assuming an average annual return close to 8% over the full period. The gap is now about $159,000. Think about that. Marcus didn't contribute an extra $159,000. He didn't receive a huge inheritance. He didn't discover a secret investment. He simply allowed time to work on a larger and larger base for longer. This is the moment compound interest appears to explode. But notice something important. Nothing exploded. There wasn't a magical year where the laws of mathematics suddenly changed. The curve only looks explosive because every previous year quietly stacked on top of the last one. That's why the biggest number isn't the return. It's the balance already earning returns. Once your investments begin generating more annual growth than you personally contributing, the engine starts doing more work than you do. That's the moment people mistake for magic. It's really mathematics. Now here's the lever that changes everything. Suppose Marcus increases his monthly investment by just $200. Instead of investing $500 every month, he invests $700. Nothing else changes. Same investment, same average return, same 20-year period. That extra $200 per month adds $48,000 in additional contributions over 20 years. But thanks to compounding, the ending portfolio doesn't just increase by $48,000. It can grow to well over $470,000, depending on the exact sequence of annual returns. A relatively small monthly decision creates well over $100,000 of additional long-term wealth. Again, the monthly increase wasn't enormous. Time did the heavy lifting. This is also why starting early often beats investing larger amounts later. Imagine someone waits 10 years before beginning. To catch Marcus, they'd have to contribute dramatically more every month because they aren't replacing dollars. They're trying to replace time, and time isn't for sale. There's another number worth paying attention to. The Rule of 72. It's a simple approximation used in finance to estimate how long it takes an investment to double. Divide 72 by your annual rate of return. At roughly 8%, money doubles in about 9 years. At 4%, it takes around 18 years. The return only doubled. The doubling time got cut almost in half. Small changes in annual return, repeated over decades, produce dramatically different outcomes. That's why compounding feels slow, until it doesn't. Real-world data supports this idea. Historical performance published by organizations tracking broad U.S. equity markets shows that long-term investors have generally been rewarded for staying invested over decades despite experiencing multiple recessions and market crashes along the way. Meanwhile, the IRS sets annual contribution limits for tax-advantaged retirement accounts, allowing eligible investors to reduce taxes or defer them depending on the account type. Those tax advantages can further increase long-term compounding compared with investing entirely in taxable accounts. Notice what those institutions don't promise. They don't promise next year's return. They simply provide the framework. The math still depends on your behavior. So what does a practical strategy actually look like? First, automate your investing. Don't rely on motivation. Schedule a fixed monthly contribution immediately after every paycheck. Automation removes emotion from the process. Second, prioritize low-cost diversified investments. Every percentage point paid in unnecessary fees reduces the amount available to compound for decades. Third, increase your contribution whenever your income increases. If you receive a raise, direct part of it into investments before lifestyle inflation absorbs it. Even an extra $100 or $200 per month can have a six-figure impact over a working lifetime. Finally, give the strategy enough time to work. Not 6 months, not 1 year, decades, because that's the horizon compound interest was designed for. Let's go back to Jake and Marcus. Jake walked away believing caution was the smartest financial decision. Marcus walked away believing simply investing early guaranteed success. Neither one actually ran the complete numbers. Jake underestimated the cost of waiting. Marcus underestimated the emotional difficulty of staying invested during inevitable market declines. The winner wasn't determined by optimism. The winner wasn't determined by fear. The winner was determined by understanding which numbers actually mattered. The real trap isn't keeping your money in cash. The real trap isn't investing in the stock market. The real trap is making financial decisions based on headlines, hype, or someone else's opinion instead of running the numbers for your own situation. Because every financial decision has visible numbers and hidden numbers. The visible numbers get all the attention. The hidden numbers quietly determine the outcome. If you're wondering what happens when you combine consistent investing with tax-advantaged retirement accounts, or how someone earning an average salary can realistically build a 7-figure portfolio without picking individual stocks, that's a completely different conversation. But before you make your next financial decision, ask yourself one simple question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.